Hello, my name is Elena Gordon with Remax Realtron Realty. I'm a team leader of the Gordon Group Real Estate team. Today is May 30th, 2020. Now, when the quarantine is lifting little by little, we are over the first shock with pandemic. And the most common question we have today from my clients, my family, my friends, what is next? How is the economy affecting the market? I don't have a crystal ball to say what will happen. We live in unprecedented times. No one experienced that before. And there is so many publications, so many different opinions about what is going to be with global and Canadian economy and what is waiting for us in the near future. Let's look at the major numbers for today. GDP, gross domestic product, went down in the first quarter by 10%. The economy shrunk. As we know, the most damage was done in March. The second quarter of 2020, GDP will roughly go down another 40%. It's something that we never experienced in our life. 40% decline in economic activity. There is so many opinions about what it is. Is it recession? Is it depression? Many people are comparing the current situation to the Great Crash in 1929. According to Benjamin Toll, CIBC deputy chief economist, it's not a depression. In depression, you're in free fall. There is no floor beneath you. You lost a job? Good luck. This is not the current situation. This crisis is different because it has an end game. And this end game is a vaccine or a treatment. By the time we have this vaccine or treatment, the crisis is basically over. The economy that is waiting for us on another side is going to be different, but the crisis is going to be over. So what we are doing now, the government, banks and everybody else, basically try to buy time. We cannot say anything about the economy without saying something about the trajectory of the virus. As our cities start to open, people will start to cheat on social distancing, and that will result in a second or third peak. We have some historical charts for the Spanish flu in 1918. You can see on this chart. So it can take up to the year. The government will be very quick on slowing down activities. It will be on and off economy, and Benjamin called it zigzag economy. It will be very hard to make any long-term decisions, and there will be a lot of volatility. And the housing market will dance on the tunes of this volatile economy, up and down for the period of year. The question is, what will wait for us on the post-virus economy? Let's look at the chart from Statistics Canada for contribution for job loss. First of all, we can see that almost half, 47% of job loss were in full-time, low-paying jobs. 1/3 were part-time jobs, and just 18% in full-time, high-paying jobs. This distribution shows that for real estate, bigger damage will be in rental market. Now, let's look at the unemployment rate. Before the crisis, an unemployment rate was 5.5%, very low unemployment rate. Now we are in the process of unemployment rate raising to 13-14%. It's about 3 million jobs that we lost. We all know that majority of these jobs will be regained, most of on temporary basis. It's not the demand of these jobs was disappeared. It's simply frozen. We will see a significant decline in unemployment rate when we will start to go back to normal. After this significant shock, there will be long-lasting damage. Some companies won't reopen. Some people won't regain their employment. From that perspective, the unemployment rate will be stabilized somewhere at 8%. So the move will be from 5.5% to the 8%. It is the move we usually see in recession. GDP will be recovering on reduced speed after the shock. We saw it in 2008, and we will see it now. The reduced speed of the economy will mean that interest rate will be low. And even if they will go up much less than in previous cycle. We live in unprecedented times. No one experienced that before. And the government response to this crisis is something that we never saw in our lifetime too. It's trying to achieve three goals. First, to inject enough liquidity to the system. Second, to provide short-term helps for the people who are impacted. And third, to create enough demand in the system. The Bank of Canada cut interest rate to 25 basis points and stated that rates will not go negative. This is a very good point because the negative interest rate is like a black hole. Once you get in, there is no getting out. The Bank of Canada is buying government bonds at the rate of $5 billion a week. The goal is not to lift economic activities. The Bank of Canada cannot do that. The goal is to inject enough liquidity into the system so banks can do their jobs and the financial system is functioning. Look at this chart, the risk of Canadian banks. It went up in February and mid-March. End of the March, the spread started to go down, and by the end of the April, it was back to normal. That means that banks are back to the position to loan if they want to. This means that Bank of Canada is successfully injecting this liquidity. Another issue is inflation. It will impact the housing market. The Bank of Canada is printing money to finance the government spending. That's basically that we call a helicopter's money. It's like taking the helicopter and throwing down the bunch of cash to the residents. According to common sense and economics rules, it will bring to hyperinflation. But before we declare hyperinflation, we have to discuss three issues. Yes, we are printing money, but it's not new money. It's money to replace lost income and lost profit. It's not adding to the system. It's basically maintaining where it's supposed to be. In order to see inflation, you need not only more money, you need to see the velocity of the money raising, the speed at which money spends, and this speed is reduced dramatically. So you don't see inflation because of that. History showed us when the US printed money for 2-3 years during the 2008 crisis, there was no inflation. Or even take a look at the Japan and Asian financial crisis of 1997. Bank of Japan was using QE, quantitative easing. Both cases are examples of printing money with no inflation. So you can have a long-term printing period while avoiding hyperinflation. That's we have now. Now let's look at the government debt. We are spending like there is no tomorrow. Already the budget deficit is up to $250 billion, and this is just a down payment because we have more to come. We still didn't see a transfer of healthcare money to the provinces or large corporations, and we still haven't seen the impact of the rent assistance for the small businesses. We'll end up with a $300 to $350 billion budget deficit for this year. The next chart is showing us that Canada's starting position was extremely good regarding debt to GDP ratio. Basically, if we will go up by $300 billion, we will still be in better position where other countries started, not to mention their upcoming increase as well. In addition, we are refinancing debt at low rates. That means if you spend extra $350 billion on top of debts, your interest payment will remain basically the same because of the ability to refinance. Every crisis is a trend accelerator. And this crisis is not unique in this sense. One aspect of this, deglobalization. Deglobalization started before the crisis, and this virus clearly accelerated that process. Because you woke up one morning and you realized that 90% of your antibiotic supply is coming from China. It's going to change dramatically because it's not going to happen again. Essential goods and essential needs will come back closer to home, with some positive implication for Canada for a long-term perspective. We will see a move from just-in-time inventory to just-in-case inventory, and this is a different model. Now, let's discuss the housing market in this environment. We all know that starting point of this crisis was very strong. The housing market was in rebound position, inventory was falling and prices were rising. The starting position was extremely good. Now you go into supply of new housing and you can see a significant decline, inability to complete housing activities everywhere. Toronto 2020 was expected to be a year of completion, with projected over 30,000 completion in GTA. This won't happen because of social distancing, delay in materials coming from Italy or China. Everything is going to slow down, especially in condo spaces. Now it's hard to say anything about the housing market because we have less supply and less demand. It's hard to base it on the small sample. As we move 3 to 6 months from now with on and off economy, we'll see some changes. Next year, if we will have no vaccine or treatment, the case will be closed and immigration will go down. It's always negative for the demand, especially for rental housing. That's something that can impact rental activities, especially condo space. If you sum all of those processes together, the market will be softened. There will be no free fall or sinking in any significant way, because the fundamentals of this market are very strong. But there will be weakness next year. If you look at the segments of the market, the low-rise market won't go down as notably as the high-rise. The most casualty will be in high-end market because there is more mismatch of supply and demand than in lower or middle price range markets. The market will be softer this year and following year, and we expect demand to be stronger in 2022 when immigration will resume. As a realtor, I'm saying to my clients that if you're a buyer and you're buying for a long term, unless you're a flipper or investor, you don't want to waste this opportunity that this crisis is providing you with extremely low interest rates and relatively soft market. If you are a buyer and you have a secure job, you're actually in better position than you were a few months ago. For the buyer, it's not the risky market, it's opposite. If you are buying for a long term, take advantage of low interest rates. If you are a seller, you have to recognize that the market is not falling apart. The market still have a lot of demand. Some investors' money will be coming. But also, you have to realize that the market will be softer. And as a seller, you have to compromise on this point if you want to sell, compared to a few months ago. We all know that location, price range and type of the property is very important when we compare one area to another. If you want to know what's happening in your neighborhood, in your market, please contact me. We can discuss it or even do a Zoom meeting where I share with you my screen and show you all stats from Toronto Real Estate Board. Please reach out to me 647-400-9603 or Yelena@gordongroup.net.